Welcome. This is our second to last before lecture video, and this week we're going to look at the owner's equity section of the accounting equation. And when I say owner's equity, that is thinking of the business as a sole proprietorship or maybe a partnership. What we're going to look at this week is still in that same section, but we're going to look at it as a corporation. Because when you look at it as a sole proprietorship, as we've done, there isn't much more to the owner's equity than what we've already done. The capital, the retained earnings, and then possibly having your drawings account. But with a corporation, it does get quite a bit more detailed, and that's what we're going to look at today. So the first thing about a corporation, and probably about this first page of notes, I'm not going to really hit this much in class, so you'll need to get what I'm saying here, and I'm going to begin talking about stocks when we get in class, and then going through briefly the example that we're going to look at here in a few minutes. With a corporation, the big thing that companies used to use a corporation is for legal protection. Now we don't necessarily have to have that because, as we talked about back in day one of the semester, there is something now called an LLC and an LLP that gives even sole proprietors and partnerships that legal protection, separating the owners from the business. So that was one of the major reasons. Other reasons now to do corporations is selling stock, being if you're a really big company, that's usually what I would say most companies become a corporation. The different types of kind of the hierarchy of a corporation, you've got your owners, the stockholders, and what's another difference between a corporation and a sole proprietorship? With a sole proprietorship, the owner usually is the management. They're the one and the same. Whereas with a corporation, you'll have outside owners who invest money but have no business in running how the company works. So owners and management are separate, which could be a good thing or a bad thing depending on how you want to look at it. So stockholders are your owners. Of course, that's the people who've invested money, so they're pretty important. Now the stockholders then elect board of directors, and these board of directors are the ones who ultimately make the big decisions in the company. And then the board of directors will then hire people who run the day-to-day operations, like the CEO, the CFO, and then those guys hire people below them who will run more detailed things within the company. So I put a few items here. Why should you form a corporation or why not? So as I said, one of the big reasons why to get a corporation is to sell stock and therefore make big money. Not make it, but at least have some access to big money. Corporations, when they get this money, do not have to pay interest like they would on some loans. They have the option to pay their owners dividends, but do not have to pay a dividend if the company isn't doing well, which is an advantage. If you had a loan taken out, you're going to have to pay back interest and pay back that loan whether or not you're making money. If you're a corporation, you do not have to pay a dividend if it's not in the company's best interest. Now, you may lose some of your stockholders, but that's just the chance you take. The separation of company versus individual owners, that's one of the good parts that was with a corporation for a long time, but now it's not necessarily all that unique. And the other thing is the ownership is easily transferred, so meaning like if somebody dies or if somebody gets aggravated and quits and moves on to their own company, you can buy them out and you would then own their shares of the stock or whatever it might be, and then you can continue the company as is. Whereas if it was a partnership or sole proprietorship, you can't do that. If ownership changes, then you have to dissolve the partnership and then make a new partnership, which can be kind of a hassle. And then I gave some ideas here on why not to fill out a corporate, or why not to be a corporation. The first one is, like with anything that's big, it's going to be highly controlled by the government. Therefore, you're going to have a lot more paperwork, a lot more items that you're going to have to, and rules you're going to have to follow, what also known as red tape. If you have a C Corp, because there's different types of corporations that you can be listed as for tax purposes, but C Corps are double taxed. They are taxed once on the net earnings of the company, and then they're taxed again when they're given out as dividends to the owners. So there is a good chance of being double taxed, which is never a good thing. Also, you lose ownership of your business if you become a corporation. If other people buy into the company, you have now given up rights, or 100% of your rights if you were the 100% owner. The last thing here that I have, to start a corporation, you're going to need to fill out, and you would have to search online to find an example, but you would need to fill out what's called an Articles of Incorporation within your home state. And then once you fill out this Articles of Incorporation, they list all the major aspects of your business, what you're going to be doing in your business, where you're located, who's your board of directors, how much stock are you going to be issuing. So a lot of the big things. The day-to-day rules, how the company is going to be run, that's kept in-house, and those are called bylaws. And those can change very fluidly. You can change those when needed. These Articles of Incorporation, those are the big points of the business that should not be changed. And if they are, you're going to have to go through a lot of hoops. All right. Now, the main part of this chapter that we're going to look at is, how do you record the issuance of if a company does sell their stock? Now, one thing before we get started that I wanted to mention is there are two ways to buy stock. And this is looking at it from a big company standpoint. The first way is if you buy it from the company at their initial public offering. That's called an IPO, initial public offering. Facebook had one of these not that long ago, just a few years back. They went public and they sold shares of their stock. That is when Facebook would have recorded their shares. After that point, Facebook has no control over who owns their shares. And that's when you begin to see items on the New York Stock Exchange. That's people like you and me then who go out and buy shares of Facebook from people who already own shares of Facebook. They're deciding to sell their shares at the right price. So when you go and buy something on the New York Stock Exchange or maybe the NASDAQ, Facebook has no idea, and they also don't record it. They only record that initial issuance. I just wanted to make sure that that's clear, because sometimes that may not be clear. My screen, if you're blinking, it's mine, and if not, it's just my screen here. I'm trying to fix it. All right, so the first type of stock that we're going to look at, that we have two types. There's two types of stock that can be issued by a company. And the first one is the most basic type. And as you can tell by the name, that makes sense. It's the common stock. We'll abbreviate it in class as CS, common stock. This is the default. If you only have one type of stock, this is the type you would issue. You can offer the second type, which we'll look at in a second. The common stock is the ultimate winner, the ultimate loser. They have the biggest risks and rewards. As we'll see with all stock, as I mentioned before, there is no guarantee of dividends will be paid to you, or different than if you owned a stock, or a bond, or like a note, where interest is guaranteed that you will get paid however often, every month, every quarter, every year. But with common stocks, there is no guarantee of dividends. The company doesn't have to pay it if they don't want to. And even if the company does pay it, first dibs goes to preferred stockholders. They get a set amount of whatever is paid, if any. And then whatever's left after that does go into the common stockholders. So that's what I mean by ultimate risk, ultimate reward. Ultimate risk meaning if they give out $100 in dividends, but preferred stock gets the first 100, then the rest that goes to common, they get nothing. But in that same example, if preferred are going to get 100, but they give out 1,000 in dividends, well, common stock gets to reap $900 in dividends. So ultimate risk, ultimate reward. And also the common stock are your owners. They are the ultimate owners who make and do the voting of the board of directors and whatever's going to happen. They have the control. The other type of stock that we're going to look at is the preferred stock. Preferred doesn't mean it's actually preferred. It just means for dividend purposes, it will get first dibs. It is preferred over common in that aspect. You get first dibs, but then you only get a set amount with these preferred stocks. And how it's determined then, how much dividend you're going to get and that set amount, it's based on the percent of par that would be listed with each stock. And an example that you'll see possibly would be maybe 20% of $100 par. We'll talk about the par value in a little while. But essentially this is saying that whatever the par value is, you're going to get 20% of that per share that you own. So if you own one share, you're going to get $20 of whatever dividends are paid. You're going to get the first dibs at that of 20 bucks. Anything else goes to the common stockholders. But the key thing to remember, and something that I'll make sure that I want you to know, is that even with preferred stockholders who get first dibs, if nothing's paid out, they get nothing. Dividends are not required for preferred or common. So when you have stock in a corporation, it's going to, at some point, typically fall in one of these 5 categories. The first category is stock that you have said in your articles of incorporation that you're going to have 1,000 total shares, that's it. And those are stock that has never been sold yet. You have them, usually just digitally, it's not something you actually have paper form. You have them, but nobody owns them yet. Once you have issued those to someone, maybe even yourself, then they become issued and outstanding. Now, something can be issued, but not be outstanding. And that happens when if you issue stock, at some point it will be outstanding, but at some point you could decide to buy it back. The corporation decides, well, I'd rather own some of my stock again. I don't want to have all these other people owning a part of the business. At that point, when you buy the stock back, it's still considered issued. It's just not outstanding. It's not in the public hands. It's issued, but you have it on temporary hold back at the company. It's issued because it's not in this original opening batch. And then the final category is you no longer have the stock issued. You have retired it. It will no longer be sold ever. So once it's retired, it's gone. It's no longer even authorized. So if we had 1,000 shares authorized and I retired 200, that means I only have 800 left authorized that I could sell. Now with issuing stock, how we do that with journal entries. The first thing we always have to look at is the par value. The par value, just to give you a real quick definition, we're going to have a par value with both, common or preferred. And the par value is simply an arbitrary amount set for legal reasons. Something you should know that it's not really important. And the only thing it really goes to show you that when the company first issues their stock in that IPO, initial public offering, they just can't sell it below that. That's kind of what the par value is. So par value, we're going to always set our common stock or preferred stock at this initial price, and we'll see that. I'm going to show you an example here in just a second. Once we look at this additional paid-in capital, we're going to kind of flip back and forth with our example. The additional paid-in capital then is anything that you sell the stock for over and beyond that initial par price. So if you sold stock that for $5 that had a $1 par, which is very common to have a $1 par, you would show that the common stock that you issued as a credit would be $1 because you value that at the par price. And then the additional paid in capital for that stock, for common stock, would be at $4 credit. And then your debit would, of course, be cash because that's what you get when you sell stock typically. All right, now in Blackboard, I have number 46. Go ahead and let's look at that. And we're going to look at the first. We're going to look at the first three. Yeah, the first three transactions here to kind of get an idea of what I mean by par with common stock. So with this first one, if we sell 10 shares and the shares are stated $1 par common stock, and the shares are currently selling for, I can sell them out on the market for $10 each. I need to ask myself, what is the company getting? Our normal debit question. If I sell stock, most of the time I'm going to be getting cash. So that would be my debit, a debit to cash. And then our credit, pull up our answer. Our credit is to common stock. But note that it's listed here at the par value, 10 shares times $1 par. We always list our common stock. Common stock, remember, that's very similar to capital. Common stock we're going to list at the bare bones price. And then its buddy account, it's not a contra account because it's not opposite, but these two always go together. The rest of the money that came in from our cash, from the cash, why we got the cash, was from our stock, and that was everything above the par price. Remember, and this is called additional paid in capital. So everything over this common stock value will end up being to finish up our debit equals credits. All right, so now the second one just goes to show that you don't always have to get cash when you issue stock. And then what you would do is you would value that item that you're getting as the price of the stock. So here we valued, of course, the cash. It was $10 a share. Here we're valuing how much of an asset did I get? And we decided it was worth about $200. So back up here, remember the stock was selling for 10, so maybe it still is selling for 10. And so that makes sense. $10 a share times 20 shares is $200 of equipment. So now I can easily do this journal entry. What did the company get? We got equipment, and it was valued at $200, so that's what I'm going to list as my debit. And then I'm going to credit the common stock for $20 this time because I sold 20 shares and the par value doesn't change. So that's $1 a share times 20 shares. And then whatever's left goes to my additional paid in capital. Now, the third one that we have as an example is the other type of stock, the preferred stock. And in this case, it's going to have a different par and usually quite a bit higher because remember, dividends are based on your par price as a percentage. So that's the whole reason why I say 10% of $50 par. If and when dividends are given out, preferred stockholders are guaranteed per share the first $5. 10% of 50 is 5. So if there's 2 shares outstanding, they get the first $10, 5 and 5. $5 for each share. Okay, well in our case, there's going to be 10 shares that are sold. We sell 10 shares of stock 10% $50 par, and the stock price currently is at $75 a share. So then we can easily do the debit and credit. Debit, what did I get when I sell them for $75? I get cash. And then just like what I did before, instead of crediting my common stock, I am now going to credit my preferred stock account. And I'm going to credit at its par value. So $50 par times 10 shares. And the rest goes into its partner account. We have an additional paid-in capital for our preferred stock. Notice it is a different additional paid-in capital. They're all in the same owner's equity section. It's kind of like having 2 or 3 different account payables. They're all in the liabilities, but we do keep them separate. All right, so that's what it looks like when we initially issue stock as a corporation. Now we're going to move on to the next piece, and this was one of those options that I said in the stages of stock. What happens if the company buys back their own stock? That's called treasury stock. When a company repurchases the stock that they originally sold to someone, but then they want to buy it back, that's called treasury stock. Notice here, treasury stock, when you have your own stock, that's not an asset. You can't be an owner in yourself. That's why it's not an asset. If you would buy shares, say this was Eli Lilly Company, and Eli Lilly wants to buy shares of some other company like Target, then yes, that would be an asset. They have the rights to that ownership. But if you buy back your own stock, that's not an asset. It's actually a contra account in the owner's equity. So it's a contra stockholders equity account, kind of like dividends. Dividends is also a contra account in that owner's equity area. When you buy the stock, it's kind of like buying inventory. You will want to keep a separate little sheet that lists how much treasury stock do you have and at what price did you buy it for? Because that's going to come into play when you sell it. Like when you sell inventory, if I sell inventory for $5 a piece, but they only cost me $4, I list the inventory as a cost of goods sold at $4, not the sale price. I'm going to do the same thing here with treasury stock. If I sell the treasury stock for more than what I originally purchased for, I need to take it back off my books at what I originally purchased it for, and then have an additional an account to show that there was extra money. So what happens here if I sell my treasury stock, if I buy it back, we'll say for $10, and then I resell it for $12, well, I'm going to show that I'm getting cash of $12. I credit my treasury stock for $10, and then the extra is just like the other guys that we were just doing. Treasury stock has its own additional paid-in capital. This is kind of like a gain account. It's not called a gain, but it's like a gain. I'm selling my treasury stock for more than what I purchased it for. So therefore, it's similar to a gain. Now, what happens then if it's just the opposite? I resell my treasury stock for less than what I purchased it for. So I purchased it for $8. I could only get, or no, $10, but I could only get $8 when I resell it. Well, then it's kind of like a loss. And how we treat that is we first take away any of our paid-in capital that we may have previously had in treasury stock. If I don't have any paid-in capital for treasury stock, or I run out, then I have to go to my retained earnings and start taking away earnings, which is never a good thing. Companies should not reach into their retained earnings if at all possible. All right, let's look at the next three entries then on our number 46. On the first one, we're buying back 5 shares of common stock for 15 bucks a piece. Now, with this one, since it being real simple, I'm not going to have a separate little sheet over here, but in class we will be doing that, is to have like a little basic inventory sheet that shows the treasury stock that I'm buying back, 5 shares and what it cost me a piece, and then the total price that I bought back. So when you combine all of this, the 15 times the 5 bucks or the 5 shares, that's $75 of treasury stock that I am repurchasing. Remember, that's a contra account. And so I'm going to debit my treasury stock because that's what I'm getting. It's a contra owner's equity. So even though the T account is increased because it's a contra, overall the treasury stock reduces my owner's equity because remember, owner's equity is a minus plus. And right now, as a debit here, that's like a minus in the overall owner's equity. And then the credit question, how did I get the treasury stock? I paid for it, $75. This one was real easy. It's when I go back to resell the stock that it gets to be just a little bit more complicated, but not tough. So here I'm showing that I'm reselling 2 shares of this treasury stock that I had just purchased, and I actually have made a little money. I'm reselling it for $17 a piece. So I asked myself, what am I getting? I'm getting cash. 17 times 2 would be $34. And then like what I did with inventory, I need to get rid of my treasury stock at what I purchased it for, not what I sold it for. I purchased it for $15 a share. So that's why my treasury stock is at 30 bucks. 15 times 2 shares. And then whatever I'm still off, that is my similar to a gain account. I actually earned money, and we call that the additional paid-in capital. So if I was keeping track, I now have only 3 shares of treasury stock still within the company, and my balance is easily calculated. 75 minus the 30 that I got rid of, so I'm down to $45 of treasury stock within 3 shares. And that makes sense. 3 times 15 is 45. Now the last example, I'm going to do it the other way. I'm selling the stock for less than what I purchased it for originally. I originally purchased it for 15. All I could get on December 14th was 10 bucks a share. My debit is still going to stay the same with cash, but I'm going to have a couple more debits to kind of help offset that cash as well. So the cash here, what am I getting? It would be $20, 2 shares at 10 bucks a piece. Now, what I would do is skip a couple lines, and let's go ahead and do the credit like we would have here. Our credit is to treasury stock. I'm getting rid of treasury, so that's my credit. But I'm getting rid of treasury that was on my books at $15 a piece, and I am getting rid of 2 of them. So I'm going to credit my treasury stock for $30. So now if I credit treasury for 30 and my cash is at 20 as a debit, my debits are too low. Remember, the first thing you do whenever you sell something for a loss, if we go back to my notes, if I sell something for a loss, we first take away any paid-in capital that we may have. And well, we do have some in treasury stock because in my last sale, I did sell it for a little bit of a gain. So the first thing I need to do is take away this gain because I call it a gain just because I think that's the easiest way to think about it. Remember, it's not actually called a gain. But I take away this gain because I no longer have any gain after I make this sale. That cut into my gain and wiped it out. And not only did it wipe it out, I have further losses that I still have to account for. And again, if we go back to the notes, if we run out of paid-in capital, this gain account, then I have to go to where I don't want to, but I have to go into my retained earnings and start taking money away there. That's similar. Think of that as like dipping into your retirement account. You don't want to do that. So I had to dip into retained earnings for that additional $6. The key to remember here, there is no such thing as a debit balance to additional paid-in capital. You have to dip over into your retained earnings. I could not put $10 here of additional paid-in capital because that would end me, if I was looking at the T account, that would leave me with a debit balance of $6. And that's impossible. Think of it like a gain. You can't have a negative gain. It just doesn't make sense. All right. I think what I'm going to do at this point is I'm going to stop the video for those that like to have 2 shorter videos. And then I'm going to create a second video for our dividend portion to avoid having one long video or longer than normal.